Good afternoon, everybody, from here in the UK, where the sun is shining and we're coming out of the slumbers of winter. It's really great to be on the webinar today from here in the UK, and wherever you are across Asia, Europe, and the US. You're very welcome indeed on the webinar. I know we've got a very strong number of attendees today, and it's a real delight to have Akim Aman, from Director of Black Label Properties, on the webinar with me. Welcome, Akim.
Welcome, thank you.
Good to see you. And also Volker March, Attorney and Partner, VPMK Legal Services. Volker, welcome. Very nice to see you.
Thank you. Couldn't wait to get on.
So delighted to have you on this webinar today. Today we are talking about 2023 in focus. We are going to be talking about relevant issues of today. Inflation, obviously that is a topic that is uppermost in people's minds. Energy, what's happening in the world of energy right now in terms of energy costs, and obviously particularly relevant to us here at IP Global on the property side, and also tax efficiency. So we will be discussing relevant matters on all these subject matter in Germany and in the UK. And as I say, it's a delight to have Akim and Volker on this webinar with me today. So let's get into the first slide. So if we start off with the first slide on the screen. So what are we going to talk about? So the agenda today is effectively those 2023 concerns that are uppermost in people's mind. Predominantly inflation and interest rates. We're going to be talking about real estate trends, sustainability. It's such a big issue in today's world, and one that affects us all. And we're going to have some really good, insightful comment on this from Akim. And in terms of tax efficient investing, I'm going to cover the UK side, and Volker, who's very much an expert on the German side, is going to talk about the benefits of investing tax efficiently in Germany. So let's move on to the next slide. So a little bit of background, first of all, to myself. I've been in the business IP Global since 2006. I joined the business pretty much at the beginning. In terms of us as a business, we've transacted on close to $4 billion of property investment since we set up. We've headlined there some of the main parts of our business. So in effect, we are present in 15 international cities. We have invested across 18 countries now across the globe. So there are many property companies who are specific to certain markets. We have a global reach that is far and wide. And we have tremendous experience. We have a very strong investment team that is seeking out opportunities across the globe. We consistently outperform year on year in terms of our projections. And because we co-invest with our clients, our success depends on your success. And it's a very strong end-to-end business model where once clients have invested, we can do everything from introduction to a lawyer, helping find the mortgage, helping with the lettings and management, and ultimately exiting with the resale opportunity. So we will do as much as we can to help the client through the property investment journey. Fine, so let me start off with a little bit of comment on interest rates. It's quite topical at this precise moment. We've just seen the Fed in the US put interest rates up 0.25% last night. We've got a Bank of England meeting today, actually in real time roundabout now. So we'll find out what's going to happen with UK interest rates shortly. And last week there was a meeting at the European Central Bank. So what do we see from a high level? Well, the positive side is that we certainly see inflation headwinds starting to peak off in certain parts of the economy, not all parts of the economy, but certainly some significant elements of the economy. So we see here in the UK a sharp fall in the price of imported goods. Wholesale energy prices, gas and electricity, have certainly come off since their peak towards the end of Q4 last year. And as the year progresses, that will certainly feed into lower energy bills here on the ground, which will be beneficial to the overall economy. In terms of interest rates, what we are most likely to see today potentially is either rates stand as they are or actually potentially increase. As I say, inflation still needs to be put to bed, still needs to be beaten, but it's certainly moving in the right direction. I think the point we'd make in the UK is that if you look at under the Liz Truss government, which was only barely 6 months ago, we were talking about significant interest rate amounts following the mini budget, potentially 6-7% Bank of England rate. We're currently sitting at 4%. Now, whether we get 1 or 2 interest rate rises or not, actually, the likelihood is that those interest rate rises will be coming to an end soon, and certainly significantly less than what we anticipated under the Liz Truss government towards the end of last year. What we are seeing in terms of inflation, though, is actually rental inflation. So there are various reasons for that here in the UK. We know that the UK market is structurally undersupplied. It's never hit anywhere near the 300,000 odd homes it needs a year in the UK to be built. It's hovered around to 200 odd thousand year on year. But actually, if you look at this year, and it's relevant to today's subject topic around sustainability, etc., there's actually talk of potentially only about 150,000 homes built this year in the UK. And that's due to the stronger regulatory requirements, ESG, sustainability, etc., which is going to feed into less property in the market. And ultimately, another reason why rental inflation will be strong in the UK for quite some time. So if we go on to the next slide now. So, if we look at Germany, I mean, it is very much sort of ditto what's gone on in the UK from an inflationary point of view. We see inflation in Germany having peaked out in October of last year, and is steadily coming down. As I say, it's not beaten us yet, but it's definitely moving in the right direction. Similarly, in Germany, we have seen energy prices, costs, oil and gas, electricity started to come off. The interest rate cycle in Germany is probably just a little bit more behind the curve to the UK. Last week, there was a 0.5% rise at the European Central Bank, albeit, as I say, I think we can clearly see that we are more towards the end of interest rate rises than at the beginning of interest rate rises. And so I think once interest rates look to peak out in Europe, which obviously we hope over the next number of months, as we get towards the latter part of the year, then hopefully we're at a point where interest rates stabilize. And then obviously as we go into 2024, that we potentially see interest rates starting to decrease over time. Okay, so let's move on to the next slide. At this point, I'm going to hand over to Akim. Akim is over in Germany, and Akim's going to talk about global sustainability trends and what that actually means right now in terms of property and what's happening in the market there. So, Akim, let me hand over to you at this point.
Grant, thanks a lot for your great explanation on our core markets. And I think just in Germany, I think a lot of you guys have seen what has happened last week in Brussels when there was a big decision on sustainability, especially in property and real estate. So all over Europe, within the European Union, within the period of 10 to 15 years, all the German developers as well, of course, but also the European developers, they have to come up with a solution to lower their carbon footprint. And the main topic is at the moment the difference between the real estate we're having on the market, so the existing stock, and the ones that we are at the moment developing, that's being built at the moment. We can see huge spread between existing apartments on the market and new builds in terms of pricing. And I'll cover in that little presentation today why is that. There are massive effects on the ESG criteria for landing and letting. You already can see in certain European countries that you cannot rent out an apartment if you don't fulfill a minimum energy standard. And I believe it's similar in the UK. Within the next few years, there will be further restrictions on not great apartments on the letting side as well. Banks are very strict on lending when it comes to the ESG. They're getting stricter and stricter. So if you are applying for a mortgage in Germany, you have to make sure that the property fulfills a certain energy standard. And what we also can say, which is a big bonus for, of course, the economy, is that a lot of existing stock needs to be completely refurbished and needs to be will have a new heating system, a new installation, a new roof, new windows. All these things are happening within the next 5 to 10 years, I would say. If you go over to the next slide, I'll just give you a couple of examples. So at the moment, that's a big German newspaper or magazine called Der Spiegel. And it's just addressing what's happening to the current homeowners, especially the single family homeowners and multifamily homeowners, just to give you a couple of figures so you understand what we are talking about. In Germany, we're having around 10.5 million single family homes. And if you want to apply the minimum energy standard, which is the level D, you need to invest around, for a single family home, around 80 to 200,000 euros within the next 10 years. And if you look on the multifamily homes, if you own an apartment which doesn't fulfill the minimum energy criteria, it depends a little bit on how big the apartment block is, your apartment is in, but the average fee is anything between 50 to 80,000 euros per apartment you need to cover for the next 5 to 10 years in order to fulfill the minimum energy standard. So that's a big topic all over Germany at the moment. And if you move over to the next slide, I just would like to show you a couple of details and why we actually do have that rather, I would call that a rigid regime now. Of course, I think we all know how important the climate change is for all of us and for our children. And I think the building sector, the property sector is a major player here. And if you can see that little green line, which has been circled in here, you see how important buildings are or real estate are when it comes to the carbon footprint. And if you then look on the forecast, how much we actually have to lower the carbon footprint and to cover the energy standards, you can see how many percentage we have to go down. You can see it's getting better and better already in the past. So we're on the right direction, but we are not fast enough. So Brussels has decided that all the European countries, they have to step in now and push the developers and push the homeowners to do something in order to fulfill the energy standards within the next couple of years. And you see that there are minus 36% within the next 3 years, and then another minus 41% until the year 2030. That's quite rigid. That means there are significant investments in the next couple of years. If you move on to the next slide, I think all of you guys have seen the energy certificates in the past. 10 years ago, 5 years ago, no one really has paid any attention to that. Nowadays, this is the first question all our clients are asking us: what kind of energy certificate does my property has? You can see that's the energy rating A+, and it goes to C or worse, to H or worse. I think H is the end. And within Europe, there are different energy certificates. They're now being all adapted to each other. So for instance, in Germany, the energy or the quality of build is pretty high, even if you look on the 60s, 70s, or 50s compared to other European countries. However, there has to be a certain percentage which falls within the class FGH. So the class FGH is something we have to watch out for in the next 3 years. And then we have to eliminate all the properties in the class E. So all the properties on the market nowadays, they have to be minimum class D in order to get a realistic funding within the next few years, especially if you want to remortgage in a couple of years' time. You do need to have the Class D. You can see there's a huge job, especially when it goes to H, F, and G. So all these properties, when you go on the portals, when you go on the internet and check property prices, this is something you definitely have to check what kind of energy class you are looking at, because it makes a huge difference in terms of pricing. You can compare that a little bit to old cars, new cars. You know, the new cars, of course, are much more expensive, but they have much lower carbon footprint emission. They are much more energy sufficient, or electric cars, for instance, the same as property. So all the old properties you're looking at here, they are really should go down in prices within the next couple of years if you do not invest a significant amount of money into it. If you move on to the next slide, you can see a little bit about the kWh. That's the system how we measure the energy consumption or the energy need of each property. So that's something you need to watch out for. So if you ever see an energy certificate within Europe, that's a standard. If I'm not mistaken, it's quite similar in the UK when you look on energy certificates. So please make sure you are minimum. You can see the green dot there, minimum D or better, in order to make a safe investment for you as an investor. If you move on to the next slide, would like to pass over to Grant if there are no further questions.
Yeah, no, you make some really good points on those slides, Hakeem. I mean, essentially, you know, energy is such an important matter these days in terms of energy costs, etc. It's relevant to buyers of property for the type of mortgage that they can get. And I know in Germany, you know, you can get better mortgaging dependent on the energy efficiency of buildings. As tenants, you're focused on that for your costs. So, you know, you brought up some very relevant points there. And actually, similar in the UK, you know, you have to have an energy rating of C or above by 2025. So it's kind of broadly similar to what you've been speaking about there. So these are very topical matters and very important matters that, you know, the audience need to be aware of in terms of how you know the sustainability, etc. is so relevant to property. So yeah, you made some very good points there. So yeah, I'm just going to come on to just a quick 2 minutes on UK taxes before I hand over to Volker, who's going to share his expertise in terms of the German tax regime relevant to, in particular, property. So here in the UK, you know, very simply, if you have a UK passport, you have a personal allowance as an individual, which is before you have to pay any tax. And then we've listed there the various bandings of income tax. In terms of capital gains tax, you are either taxed as standard on property at 18 or 28%. You do get an allowance as an individual of £12,300 each per individual as your rights. But the reason I just wanted to put this slide up was because it kind of leads into the next slide very well, which is basically in terms of there are actually more efficient ways to invest in property in the UK now, and that is through a company structure. Now, it's become ever more popular. I think last year in the UK, 2/3 of transactions were in a company structure. Why is that? Well, one of the reasons is actually it's become easier to get mortgaging through a company structure. But also there are a whole host of advantages that actually really supersede the slide we just had up in terms of the benefits of investing. So for example, through investing in a company, effectively there are benefits for income tax. There are benefits in terms of your limited liability because you have a company structure, and that's important from a property perspective. You are able to buy and sell property easily if you put it in a single company structure. In terms of how you structure the actual shares allocation within that company, and also you can gift your shares away within the company. So actually you can mitigate some inheritance tax planning. As I say, I don't want to go into too much detail on this presentation because we are covering different subjects. But the point I would make is, if you are keen to delve into this in more detail about the benefits of a company structure, then do feel free to drop a line after this webinar or raise any questions as we go through, because there are a number of advantages for investing into this sort of setup as highlighted onto the screen here. Now, at this point, I'm going to hand over to Volker March. Volker is working with VPMK, based in Berlin, and has considerable expertise in this field. So, Volker, let me at this point hand over to you.
Yeah. Thank you, Grant. Let me quickly say a few words why I wanted to talk about that subject today. So as you said, I'm working with VPMK. I'm one of the founding partners. We started that firm about 25 years ago with the idea of focusing on international private clients. And in my case, that is helping clients with real estate investment. So usually privates who want to purchase 1, 2, 3 apartments in Germany. And the main work we actually do is to help them overcoming these legal and administrative challenges that an investment abroad can have. But of course, I mean, we've helped more than 1,500 clients buy their real estate in Germany, like individual clients, over the last 10 years. So there has been a lot of talk about tax matters, about what the taxation will be, how is it going to be when you exit. And so I had seen that there are actually 2 aspects that often make people a bit nervous about the German system. That one of them, that Germany doesn't give a personal allowance in general to non-residents, and the other one that they have this progressive tax rate, which goes up to a number of up to 42%. So that number often makes people very worried where they would pay a lot of taxes. But we looked quite a lot into that, and actually the answer is it does have quite a beneficial tax system. It just does it in a different way than most other systems. So not by giving a very low fixed tax rate, and also not by the personal allowance, but by basically excluding a large amount of the income from the taxation as a whole. And the way that is done is one part is of course by allowing a lot of deductions, and the other one is by a fairly high depreciation. And to understand what that means and how beneficial that is, actually, I usually use an example which is along some up to current properties that we work with. In this case, we've chosen an apartment which is 375,000 euros. That is kind of a bit above the average of what clients are currently investing in an individual one. The clients here have a mortgage of 62% roughly, so 235,000 euros in mortgage, and the net cold rent for the apartment is 20 euros per square meter, which makes it 1,300 euros a month in net cold income, 1,340. So if you take that income, you have about 16,000 euros income a year. What you can deduct from that income is the interest on the full amount, which with the current interest rates brings it up to 8,137.5. I don't want to say the current interest rates are great, but at least you can deduct them fully, and it helps you keeping your taxes down. When that interest rate goes down a little bit, then the profit will be a little bit higher, and then this may have a small effect on the taxes, but it will not be a big effect, because the next one is the depreciation, which has actually been increased by the 1st of January for new builds up to 3%. So here again, we have a big advantage of new builds over older buildings. And so this 3% makes actually a big difference. They depreciate the building value only, so not the plot. So that's why you only take 70% of the total purchase price. And here, this is 262,000. 3% on that is 7,875. And we end up with a taxable profit of 93 euros. And this is, of course, great, because first, you don't pay any taxes on the amount that is deducted before, and it also keeps the tax rate down, because the progressive tax rate starting at 14%, you're very close to that here. You have an income tax of 13 euros or 6. That also pretty much reflects our experience that clients who buy real estate with a mortgage usually don't pay any taxes in the first years, and then slowly they start paying taxes because the interest portion of their mortgage payments becomes smaller. So the other part where people are often curious how it works in Germany is what you see on the next slide. That is what happens when I sell my property. I think the UK has a separate capital gains tax there. Germany assumes runs this under the income tax as well. So you have the same general rules, you have the progressive tax rate and everything, but there are some quite attractive exemptions from that for private investors. So that's probably also the reason why the buying through a company is not as popular in Germany for private investors as it may be in the UK. So if you are a private investor, you are exempted with the profit from the taxes in total if you had the property for 10 years. Yeah, if you held the property for 10 years, then you don't have to pay any taxes on the profit. And these 10 years start from the time you close the contract. So usually there's 1.5 to 2 years of building time. Those are deducted. So by the time you get the keys handed over, you have only 8 years to go. And that is quite attractive for most investors, Germans and foreigners abroad, for Germans and foreigners alike. So that is very much used in Germany as well from German investors. And the other exemption is that if you have been using the apartment for yourself in this year of the sale and the 2 years before, that makes it, if you are good with the timing of it, it's about 1.5 years minimum, then you are fully exempted from taxes as well on the profit. So that is an option if it works for your plan. Sometimes we have clients who buy apartments for their children who want to study in Berlin, and of course that gives you a lot of freedom to do that and afterwards sell it tax-free. Now, so this was like the 8-minute run through the most important questions about German taxes. I hope this gave a little overview.
Volker, if I may have a question.
Yeah.
On the current tax regime in Germany, I think they have changed the depreciation measure for new builds and energy efficient builds this year. Is this correct?
Yeah, they did. So before it was 2%, and that is still the case for the older buildings or for the existing buildings. But for everything that's been completed after January 1st, 2023, you have a 3% depreciation.
Thanks, thanks for that, Volker. That's some really good points. I mean, the depreciation is such a positive thing for investing in Germany, and that's a very good point you make there, Akim, in terms of the incentive, if you like, for higher quality property in terms of the 3% depreciation. So it's good. Yeah, it's the combination, especially of the depreciation and the tax freedom at the end, because that it really is a tax benefit like that. Yes, yeah, it's good to see the tax and sustainability working in good partnership there. So that's very encouraging.
Right. I also have a question for you, if I may. I have a question for you regarding the banks. I mean, you've seen the Fed yesterday and the ECB last week. And you also have seen what has happened to the banks in the US. There are a couple of banks in trouble. What do you think? How does this affect our market?
Yeah, I mean, I think there's a couple of points we can make. I mean, I think obviously, if you go back to sort of 2008 with Lehman's, etc., that was something that really came from sort of left field in many respects, and we was all unprepared for. But if there was one positive from that situation, there was a whole raft of stringent sort of banking regulation that came in post 2008, which actually is kind of benefiting in today's situations that we've seen with the bank in the US, where we've seen with the fact of Credit Suisse getting into trouble and the UBS takeover, and the fact that essentially there is in a number of quarters much more confidence in the banking system right now, given that enhanced regulation. But on the flip side as well, of course, it feeds into people's psyche, and the fact of that people think, well, actually our banks are safe as we all think. It's why property we see as more and more of an asset class that people are more focused on. The fact that bricks and mortar is something that people do feel as the world we live in and all the uncertainties around the world, they do feel that confidence and belief in, albeit, we don't like higher interest rates, but we like the fact that, in terms of old-fashioned investing, you can put 30% down, you can effectively get a decent yield. You can definitely get a renter in city centres across the globe, and particularly in the UK and Germany, the rental markets are super strong for a variety of actually similar reasons. Slow planning rules and regulations, growth of populations, etc. Post-COVID sort of explosion of new renters. So it's quite interesting that the sort of world we live in does feed more and more into the asset class of people investing in property, because they feel more comfort in that asset class given all the uncertainty.
Thank you.
Yeah. Achim, I have a question to you. So I spoke to a client yesterday who is currently buying, and we had a little bit this talk about the markets, how they are now, and that definitely, of course, the increase in the interest rates has slowed down the markets a little bit. And I actually asked him why he invests now and whether he has some particular plan there. And he was basically saying, he had bought before in Berlin, and he basically said, look, to me, this is a little bit, it's not repeating, but it's a little bit a parallel to the story of Berlin in 2008. So at that time, no one was building it was very hard to get a yield that would cover your mortgage, or to make it cash flow neutral. But because there was such a low activity on the market in terms of building and new apartments become ready, then he basically had eight years a head start, and when the rents were actually going up. And he said he thinks that more or less the same is going to happen again. So right now everything is slowing down. Everybody's a little bit in a shock, but in a while, the lack of apartment is still there, and we're going to see that the apartments that you buy now are becoming more profitable again. Do you think this is a correct assessment? Do you think it will be such a movement again?
Yeah, no, I think. Yeah,
sorry.
So just before you answer that, Achim, just to tell the audience, do put forward your questions now, because we'll get into questions quite shortly as we sort of close out the presentation. So yeah, do get those questions in. Achim, yeah, please go ahead. Yeah.
First of all, I would like to say thank you, Volker. Does this client has a lot of brothers and sisters who think as like? If so, I've seen quite a few of them coming over. We had the biggest jump coming in from international investors into Germany since 8 years. This quarter, we had the second strongest quarter at Black Label since 2011. Huge amount of people are investing their money because it's a 4% interest in Germany, 30% deposit, or let's say including transaction costs, 40%. And they all just want to profit from the negative interest rates. We have very strong rental market. We have vacancy rates are below 1%. That means that if we publish a listing on rental side, it's within 5 minutes we have 30 applicants. It's really crazy. And so this is because all these people who are basically priced out of the purchase market, of the buyer's market, have to rent. So the rents are going through the roof. We had 27% increase of rent within the last 4 months. 27% increase of rent within 4 months. This is the sharpest rent jump ever. Well, ever since I'm now in my 40s, since I'm working in this field. And I have to say, a lot of investors are coming back from Ireland, from the UK, from the US. The US seems to be very strong with their currency. The currency is another big topic we haven't addressed today. But as I think, especially for international investors, they're used to invest in Germany with a higher deposit than the Germans. And we see a lot of transactions happening. A lot of people are contacting us. So thank you for asking the question. I fully agree. That's basically what people, they buy when the market goes down and they sell when the market goes up. And at the moment, the market rather goes down or is stable. It's not really going up. So these people are buying now. I think they make a good deal. Yes.
Yeah, no, I would agree with all of that, and it's also very relevant on the UK side. I mean, we see occupancy sitting at sort of 99% typically across our sort of whole portfolio of over 5,000 properties in the UK. We as I mentioned to you, there's talk of just 150,000 homes being built in the UK this year, which is an incredibly low figure. You're quite right. I mean, economically, we've seen less people buying than normal given higher interest rates, but that feeds even more into an undersupplied rental market. And of course, as rents go up, and I think we see rents going up for a period of time, given the undersupply, that actually helps to compensate for some of these interest rate rises that people will have on their mortgage. But the currency side as well that you mentioned is a really strong point, because of course if you're holding Hong Kong dollars, US dollars, Singapore dollars, the euro is just starting to tick up a little bit given the interest rate rises. So it's very good value, but it could be just absolutely the perfect time to get in from a currency perspective as well, investing into the euro, into the GBP right now. So I think the point you mentioned about currency is extremely valid as well.
Yeah. Grant, there was a question, Grant, sorry to interrupt you, in the chat. They're just asking a question. If I may read that out loud to you. Do you expect there to be as many interest rate increases this year as there were last year?
I personally don't. I mean, I think, and again, if you went back to November, I think of last year with the mini budget, the Liz Truss government, the uncertainty in the money markets, etc., I think there was a sense that interest rates would increase all the way through this year. I think that this year you may see a couple more interest rate rises and then they tail off. So I think that in terms of where interest rates are, in terms of what's going to happen in the months ahead, I think it's a much better outlook now than it was towards the end of last year under the Liz Truss government. But not only from an interest rate perspective, but also from a mortgage rate perspective, because at the end of last year, lenders just didn't know how to price their mortgages. I mean, there was so much uncertainty. You were talking about 5-year mortgage rates, sort of round about the sort of 6% plus mark. And now we're seeing 5% mortgage rates, even with interest rates having gone up, as low as sort of 4.5%. And that's because of the fact that lenders can price their mortgages more appropriately. And now there's a lot of competition in the market. So I just see the UK in a better light now from an interest rate perspective than at the end of last year, Akeem. Yeah,
I would confirm that for the European market, especially for Germany. Yeah. I think we're now, I think that the interest rate went up for local taxpayers from 0.8% to 4%. Yeah. We're now at 4.2% with a low deposit, and if you increase the deposit, you maybe get 3.8% interest rates. And for the national investors, we're talking about 4.5%-ish interest rates, which if you write off the depreciation, which is 3%, then you have the inflation, which is anything between 6 to 8. At the moment, you're actually making a huge profit just looking on how much the equity costs you plus, depreciation and interest rates. There is another question, if I may read that out. Maybe that's something for you, Volker. What market in Europe would you buy in if you had to choose one in 2023? What's your favorite country, Volker? Don't
Well,
say England, please. And don't say Germany. You're not allowed to.
I'm not allowed to. I'm not alled to say Germany because I would, of course, buy in Germany.
Otherwise,
I know
Grant
the
and
market
me, we
best.
have a talk. You know,
It's
we have to be neutral. Joking.
Yeah, no, I can't. I mean, I'm surprised you think I'm the best one to answer that because I don't really have an overview about the other markets in Europe. But I mean, no, I mostly know about the German market, and I think that is an attractive market. I don't do comparisons, or I can't really answer that.
Yeah, if I would respond to that one, I think it's first of all, before you decide on a country, you should ask yourself why you invest into property. It's up to you. It's your personal. You should focus on yourself as a person. What kind of person are you? And I think the UK and Germany are pretty safe investment markets. There might be other markets within Europe which are not so safe, but which promise higher yields, higher growth potential. But that's again something it's up to you. What kind of a risk person are you? And I think only after that has been clear, I think then I would, look into the different markets. And of course, Germany is like a blue chip market. It's very safe.
So
rents are safe. Yeah.
So you say it depends. That's a very attorney answer. Okay.
There's a couple of other questions here that are coming through. So let me just ask these. So one of these actually, do you see more capital appreciation for energy efficiency buildings? So maybe Akim, I'll ask you that question.
Yes, absolutely. And it's for instance, we just launched a project, and the banks are giving 0.8% up to 1.4% interest. Plus, they subsidize the buyer. There are government-owned banks. That means you can buy a property with 50K deposit, which is 500,000 euros on the market. Is the new build, but it has to be carbon footprint neutral. That's a big topic. Of course, that's more expensive to build, but there are no running fees for it once you have built it. And there was a good piece of one of the architects we have spoken to. He always asks us, "Hey guys, if you build a property there, of course you have to pay for it and you have to borrow money against it, etc. But you don't forget how much money you have to invest into the property over a life period of 30 years, 50 years. And if you add all these costs together, you have a similar amount than the purchase price. And that's a big one. So within the next 10 to 20 years, that's a big topic. So, and the banks actually have changed the valuation process significantly. So, thank you for the question. I can definitely answer it with yes.
Yeah, no, it's interesting because of course, if you're buying a new build from an investor with a high energy rating, then obviously the investor, if they sell that property, their end buyer is going to get a good mortgage in terms of the energy rating. So presumably that's going to be positive as well in terms of capital appreciation.
Also for the rental income, if that's a big one. I mean, if there are no gas heating bills, no electricity bills whatsoever, it makes a huge difference for the investor as well because he can ask for a higher net rent.
Yeah, that's a very good point. I mean, that's huge given obviously we know the impact that energy costs have had. So that will definitely be something that tenants will be looking out for. I've got a question for you here, Volker. I mean, can you see anything negative on the horizon for the German sort of tax regime, if you like, relevant to property? That's a question that someone is asking here. So it's a very attractive regime of tax that you have there with a depreciation, withholding for 10 years and no capital gains tax. But obviously people are always looking to see, is there any likelihood that this may change at all, I suppose, is perhaps what the questioner is asking.
Currently there's really no talk of making that in any way less attractive. And I think to do that would also have meet quite some opposition because the amount that is being built is not even close to covering the demand. I think it was the government gave out the plan that they wanted to build 400,000 new apartments per year, and they managed 230 last. Of course, it was special circumstances and everything, but still, they will rather come with they might come with new incentives to maybe make people invest. However, I would expect that this will not really be for the investors more, but more for self-users, that they will try to make it more attractive for families or so to build their own homes. I think for the investors, the case is the taxes are going to stay more or less the same. I mean, if it gets dire enough, the apartment need, if it isn't yet, then they might even increase the depreciation or come with some special incentives for especially energy efficient houses. But there's no specific talk about that right now. So I would expect it stays the way it is right now.
Okay, well, that's a very positive note to end the questions on this presentation. There are a number of others, but we like to keep these webinars quite succinct and quite concise. We know that people just allocate a certain amount of time, so we don't want to lose anyone. But we will follow up with the other questions in due course. But yeah, I mean, it's been an absolute pleasure to have yourself, Hakeem, and yourself, Volker, on this webinar today. I think it's been certainly very, very insightful to get your thoughts in your specialist fields in terms of, you know, what's going on in the market from the tax side, Volker, to obviously the property, sustainability, energy, and all the various aspects of the new world we live in for property investing, Hakeem. So yeah, it's been a pleasure to have you both here. I think we've covered some good ground as well in terms of inflation, in terms of the outlook for interest rates, and as I say, hopefully it's been quite thought-provoking for the attendees today. So may I just ask for any closing thoughts, Hakeem and Volker, before I wrap up?
I think from Volker, if I just may, from my side, I think if there are any further questions after this webinar, please feel free to contact me. I mean, you'll find our website, it's blacklabel-properties.com, and just refer that you're basically coming from IPG and that you have seen the webinar. I'm happy to respond to your question. There have been a couple of more, of course, which would be very detailed. Grant, thank you for inviting me today, and I hope I could deliver some insight for you guys.
Thank you, Hakeem. And Volker, over to you for closing thoughts.
Likewise, just if you have further questions, please feel free to contact us, and we'll try to answer them as thorough as you can. And yeah, let's see how it develops. I think the situation right now, even if it's not all positive, I think it gets much more predictable, and that actually is the big positive news, that we know where this is going, and there's pretty much I think a positive perspective.
Yeah, no, and I'd agree with your thoughts there, Volker. And I think knowledge, at the end of the day, knowledge breeds confidence, as they say. And I think people can take a lot away, hopefully, from this presentation that gives them confidence in their decision making for investing as well going forward. So yeah, thank you again, Volker, Hakeem. Thank you for attending this webinar. I hope you found it insightful, informative. As I say, if you have any other questions, do feel free to drop a line, and we will respond to those and connect you with Hakeem and Volker accordingly. So all that remains me to say is thank you very much indeed for tuning in, and we look forward to seeing you all soon. Thank you very much indeed.
Thank you. Bye-bye.
Thank you. Bye.
Bye-bye.